Hello friends, with you James, and this is my first video on the channel in which I will tell you how to start trading in order to get a stable income from this exciting activity. If you like this video format, put a like, write a comment, and if we get 50 likes in this video, then I will do the second part. In this video, I will focus on the main tool of each trader, charts. A lot depends on the choice of the chart, the method of analysis, the interval of holding a position, and the chance of successfully closing a position. If you're just starting your journey, don't worry, I will not use complicated terms, show formulas, and try to be clever. Over the years of trading, I have realized that it is better to use and understand simple things than to complicate my work with a bunch of indicators and incomprehensible charts. Trading charts, also known as just charts, are graphical charts that display fluctuations in the value of an asset over a certain time period. Let's take a look at the chart of popular Euro and USD trading pair. Here we can monitor the price change to the nearest second or go back in time to see how the value of Euro and USD changed yesterday, last week, or a year ago. According to most experienced traders, the market is cyclical. This means that the value of an asset usually tends to repeat its movements at certain time intervals. It is this pattern that allows you to analyze previous data and form forecasts about the future behavior of the asset value. The term time frame is widely used in trading to denote time intervals. This definition refers to what time period each point on the graph corresponds to: minute, hour, day, week, and so on. There is a division into long or high time intervals, usually including periods from 4 hours and above, H4, D1, MN, Y. Short-term time frames cover intervals from several minutes, M1, M5, M15 to several hours, H1, H4. Choosing the right time frame is a simple process. You simply select the required time interval and analyze it. Everything is quite simple and clear. The graphs differ depending on the selected time interval, but this is not their only classification. Charts also differ in the type of information displayed. Charts can be presented in the form of simple lines, bars, or candles, depending on the user's preferences. So let's consider each of their varieties in more detail. A line graph is the most basic form of graphical representation of data. It is constructed by connecting points representing the values of a variable on the y-axis depending on the change of the variable on the x-axis. This is an excellent visualization tool for tracking trends and changes over time. This type of charts has its advantages. Easy to read, line graphs are easy to read even for beginners, and intuitive. Trend tracking. They help to identify the general direction of price changes without market noise. Low CPU load. If you have a weak PC or phone, then by opening the line chart, it will definitely load and you will be able to open transactions quickly without a long delay. Most often, line charts are used to quickly access the overall price dynamics. Since only one glance is enough to access the direction of the trend, up or down. You may have already seen the line charts in the news or on the websites for traders. They are used because of their visibility, but to be honest, they will be of little use to you in your work. Unlike the following type of chart bars. The bar is a vertical line that visually displays the price range for a certain period of time frame. The upper and lower ends of the bar represent the maximum and minimum prices, respectively. The horizontal line to the left of the bar indicates the opening price, and to the right, the closing price for the selected period. If the right serif turns out to be higher than the left one, this indicates an increase in the asset price for a given period. Conversely, if the left serif is located higher than the right one, this indicates that the value of the asset is decreasing. The size of the column itself also matters, as it demonstrates the activity of bulls and bears. If the bar is short, it indicates that the asset is not in use or hasn't been in particular demand for a given period of time. That is, neither buyers nor sellers have any special interest in it. This type of chart is most often used by users from the USA and Western European countries. This has happened historically, since this type of chart has much more advantages over linear charts. Completeness of information. Bars provide more complete information about price movements. We know not only the closing price for the selected period, but also we know the opening price and fluctuations. Convenience in analysis. Information about the opening, closing, maximum and minimum prices makes the analysis of bars really professional. Also, universal language. When you communicate with other traders or study their charts, you will encounter bars and will be able to understand each other. And the last type of graphs, which has a very complicated name, but it is very easy to understand, Heikin Ashi. Heikin Ashi charts are designed to more accurately display trends and reduce noise in the market. Each bar on the Heikin Ashi chart is a combination of data on the opening, closing, high and low prices for a certain period of time. As a result, we see a picture with pronounced trends. Take a look for yourself. By the way, if you can't wait to try yourself as a trader and start opening deals on your own, then it's best to start with this type of charts. Heikin Ashi are as informative as bars, and it is easier to determine the trend on them than on a linear chart. You just look at what color the last 3 Heikin Ashi are. If green, then you open a deal up, and if red, then down. The probability that the trend will continue in the same direction is very high. What we can't say is, looking at the bars, the probability that the next bar will be the same color as the previous one is 50-50. So dear friends, I'm finishing my first video. We have considered various types of charts reflecting the dynamics of prices in financial markets. I hope this information wasn't only interesting, but also useful. So we started by looking at line charts, simple but powerful tools that display price movements over time. Then we moved on to bars that provide more detailed information about the opening, closing, high and low prices. This type of charts gives traders the opportunity to analyze the market more deeply. Finally, we studied Heikin Ashi, where smooth trends and noise reduction create a more visual representation of price movements, so it is a powerful tool for traders to make informed decisions based on strong trends and key pivot points. It is important to remember that every trader can choose the type of chart that best suits his style and strategy. And remember to use chart analysis in combination with other tools to make informed decisions in financial markets. I hope that I have given you the necessary information with which you can start your exciting journey from beginner to pro in the world of trading. So my friends, we've come to the end of this video and I hope you found a lot of useful information here. If you have any questions or if you want to learn more about this topic, feel free to message me on Telegram. I'm always ready to help and share my knowledge. Also, don't forget to subscribe to my channel to stay updated all the new videos and updates where signals are also posted. Click the subscribe button and the bell icon so you don't miss any of these videos. And remember guys, trading is an art that can be mastered, and with signals and the right education, you can achieve success. Thank you for watching and see you in the next videos on my channel. Good luck with your investments and trading.
Keep on moving on.